My guest today is John Carter from SimplerOptions.com. We're talking about his favorite options setup. So, John, I know that's a broad question, but give us an idea here.
Well, it kind of depends what your goals are for your account. One of the ones that I like the best usually is the ones that take the least amount of effort. You don't have to sit there and stare at the screen like every tick, wondering like what's going on. So I like to look at things on a weekly chart. You get something whether it's an Apple or a Rackspace or a VMware, or even some of the stocks that are up and coming, CTRX and things like that. What happens is on a weekly chart, they get to the point where they start to consolidate and take a breather. And on that, what I like to do is look at options that are actually out of the money, so Delta 20s, that are 3 months out. And what happens with that is that because of this weekly consolidation, what you're looking for is a stock that's building up energy to make a move. Now, normally I don't like buying out of the money options, but in this particular case, what happens is you've got 90 days, okay, and the stock has been consolidating and building up energy, and it's very possible that you could buy something like a Delta 20 option that over the course of 3 months turns into a Delta 80 or a Delta 90 option, meaning you can buy something for 50 cents and then it ends up going to $5 or $10. So what I like about this setup is that you can risk a very small amount of your overall portfolio, and if it turns into a 10 or 20 bagger, which is very possible, then suddenly the risk-reward scenario is amazing because you're risking 1 to make 10, you're risking 1 to make 20. But what I like about that is most of the time what people are doing when they're focused on cheaper options, they're focusing on cheaper options that expire in a week or that expire next month, and that kind of stuff is unforgiving. If you're wrong, you lose everything. If you're out 3 months and you've got a specific setup of consolidation on a weekly chart that actually has a probability of moving higher, then you've actually got a real shot at turning that into turning nothing into something.
Now, is this the perfect time to be buying options because the VIX is so low that you'd rather be buying them than selling them these days?
Well, it's a good point because there's some things that you can do in selling options on weekly options like Priceline and things like that. But if you are looking for longer term options to hold on to, it's a perfect time because the options are literally cheap with the VIX being so low.
Right. Is there a specific sector that you like? You mentioned a few stocks at the beginning there. Is it all over the place just based on what you're looking at that day, or do you have a basket that you work with?
I generally like for stocks like that, it's not so much a sector, it's a specific criteria of how big this company is. So there's 3 main things. 1, I like to look at stocks that have got a market cap of under $10 billion. 2, I like to look at stocks that are at or near all-time highs. And 3, I like to look at stocks that are 5 years old or less. And what I find is that in those situations, these are the up-and-coming companies that are going through growth phases, okay? Microsoft's already had that growth phase. So these are the type of companies that can have big moves on the underlying stock in the course of 3 months after a period of consolidation at all-time highs. And that's found it's one of those things that offers a very unique opportunity.
Yeah, that's a little counterintuitive too, because I get that a lot of newer traders might say, well, if it's at a 52-week high, why am I buying calls on this thing? But you're just playing the trend, right?
It's not only playing the trend, but it's when you get these companies that go through a high growth phase. I mean, if you remember, so Microsoft came out public, $785 million market cap. It made new all-time highs thousands of times, on its way to where it was going. So it's, a lot of times you look at a chart and think, oh my gosh, this looks crazy. I don't want to pay this much for it. Rackspace is a good case in point. In July 2010, that was a $20 stock. Everybody thought it was overvalued. Oh my gosh, I don't want to touch it. It had a weekly consolidation. It exploded and it went to $45 over the next 3 months. That was a company that fit all those criteria. At the time, it only had a $2 billion market cap. It's near all-time highs, et cetera, et cetera. And what's happening is that you've got a unique situation of a company that's going through growth phases as opposed to trying to maintain what they have.
John, thanks for your time.
Thanks for having me.
You're watching the MoneyShow.com video network.